Hello and welcome to another Paraplanner Assembly short technical video. I'm pleased to be joined by Elaine Cruickshank from Aegon again, and today we're talking about shares and capital gains tax. So let's start off by looking at how to work out a capital gain.
Thanks, Richard. So at its simplest, the capital gain on the disposal of shares or units would be the market value of the shares or units less the cost that those shares or units were bought for, and that would give you your net gain or loss. But there are some complications that we'll look at in a minute around what cost goes into.
It was so simple. It was so simple until you said that.
It's like everything with tax, there's always little nuances.
Yeah, but we've got a few to look at. So let's start off by looking at the matching rules.
So effectively, when we look at what cost goes into the calculation, there are some matching rules that have to be considered for individuals, and these rules will actually make a difference to the end calculation. So basically, any disposal of shares or units are matched. So if I take a step backwards, where someone disposes of shares and it's a full disposal and they don't buy the same shares back, then it would just be the average cost that would go into the calculation. But if they sell shares and that same person buys back shares in the same class of the same company or same fund, then there are these matching rules. And what these matching rules mean is that in the capital gains tax calculation, if they buy back the same shares on the same day as they dispose of the shares, then it's that cost that will go into the calculation. If they buy back the same shares within 30 days after the date of disposal, it's that cost that goes into the calculation. And that's what's known as the bed and breakfasting rules. These are some tax anti-avoidance rules that HMRC brought in to counter tax planning arrangements where people were effectively selling shares to make use of their annual CGT exemption and then buying them back within the 30 days. So effectively, they held shares, they sold them down, made use of their CGT annual exemption by crystallising some of the gain, and then they made the exact same investment again. So it was as though they had never actually disposed of the shares because they still held the shares. Finally, the cost that would go into the calculation, if we've exhausted these other two possibilities, would be the average cost.
Used to be so easy, didn't it? So, pesky revenue.
It did. It was really to counter the fact, as I say, that people would be selling down a specific fund and then they would buy back that same fund on the same day or within the next 30 days. Yeah. And that's these bed and breakfasting rules. But I mean, the individual could actually sell the shares, for example, and then buy them back within their SIP or buy them back within their ISA. So that's bed and SIP or bed and ISA. And that way they would get full use of the CGT annual exemption because it would be the average cost that would go into the calculation. Or, for example, they could sell them down and their spouse could buy them back. And again, that would make use of the average cost. So it's just worth bearing in mind that we have these special matching rules or bed and breakfasting rules.
Okay, so let's start off by looking in a bit more detail at the same day rule, shall we?
Yeah, so in this scenario, we've got Jeremy who bought 250 shares in ABC Limited in 2017. He then sold them on the 5th of July 2019 for 770,000, and he bought them back on the same day for £7,740. So his capital gain would be the sales proceeds of 770,000 less the cost that he bought them back for on the same day of £7,740. Now, you might have thought it would be 5,000 that should go into that calculation because that's what he bought them for in October 2017. But because he bought back the exact same shares in ABC Limited, it's actually the cost that he bought them back for on the 5th of July 2019 that goes into the capital gains tax calculation. And
that's exactly what this rule was designed to stop happening, wasn't it? Was using the base cost. So that's one thing. So how about 30-day rule then?
So 30-day rule, again, similar scenario. Richard buys 1,000 shares in XYZ Limited in February 2013. He then sells them in June 2020 for 10,000 and buys them back for 10,200 on the 30th of June 2020. What would his capital gain or loss be? So again, in the scenario, it's the sales proceeds of 10,000. And again, because he bought back the same shares, so he bought back shares in XYZ Limited, and within the 30-day period, it's the £10,200 of cost that goes in the calculation, rather than the 5,000 original cost that he had bought them for in February 2013. So you can see that he incurs a loss of £200. Now, if he had, just to clarify, if he had sold the shares in XYZ Limited and had actually bought shares in ABC Limited, then it would be the 5,000 cost that goes into the calculation. It's just the fact that he had shares in XYZ Limited, sold them, and then bought back shares in XYZ Limited within the 30 days of the sale. That's why you've got these special rules applying.
Okay, then if we don't use the same day and the 30-day rule, we've got the average rule, haven't we, that applies?
That's right. We've got the average rule that applies. So the Section 104 holding, or the average cost that applies. So you can see in this calculation, John has bought shares over a number of years. So he has a total shareholding currently of 13,000 shares, and the total cost of those 13,000 shares is £3,000. So if he were to sell 500 shares on the 30th of June 2020 for £15,000, his gain would be calculated as follows. So you've got the sales proceeds of 15,000 less the average cost. So you've got 500 of his 13,000 shares are being sold, and it's a proportion of the cost then that comes into the calculation. So 500 divided by 13,000 multiplied by 3,000 gives you a cost to offset of 115,000. So you can see in this calculation, his gain is 14,885. So you'll be able to use his CGT annual exemption to offset some of that.
So it gets a little bit trickier, doesn't it? When we've got units, particularly accumulation units or dividends being paid, that gets a bit trickier, doesn't it?
That does get a little bit trickier. So I just thought that I'd finish off by looking at an example where John has actually invested in an accumulation fund. So he's bought some units, and in June 2015, and because he has bought the units between the ex-dividend dates, when he bought the units, the cost of £2,000 includes income up to the date of purchase. So in the capital gains tax calculation, he actually gets some relief for what is known as an equalisation payment. So at the end of the first dividend period, when the dividends are declared, there'll be a tranche of dividend that's equalisation, and there'll be a tranche that's subject to income tax, and that breakdown will be shown on the consolidated tax vouchers. It will give a detailed breakdown between what's equalisation payment and what's dividend that's subject to income tax. So as you can see, equalisation payments are deducted from the cost in the capital gains tax calculation, because the cost obviously includes that income to date. And then you add on, so any dividends that are accumulated or reinvested into the fund, they are additional costs in the average or pooled cost calculation. So you can see here that over a number of years there are reinvested dividends. So when he comes to sell the 500 units in June 2019, his capital gains tax calculation would be the 15,000 sales proceeds less the average cost of 500 divided by 10,000 multiplied by his average cost of 2,184. So that gives you a cost of £109 to offset against the sales proceeds of 15,000. So it gives you a net gain of 14,891.
And that is a classic exam question right there. I really don't enjoy capital gains tax. And if any of our paraplanner viewers know of some decent software out there that doesn't cost an absolute fortune to work this out, please share this with us, because we'd love to know.
Fortunately, a lot of the capital gains tax tools that are available on the platform, so our tool, for example, when you look at the realised gain or loss reports, it will show what method has been used, and so it will show whether it was the same day or 30-day rule or the pooled cost. But in the cost, you can do a cost-based inquiry, and that will show whether dividends have been accumulated and actually attribute to a higher book cost in the capital gains tax calculation. So you can interrogate the tool.
Brilliant. Thank you, Elaine, once again for sharing your expertise. Thank you for watching, and we'll see you again soon.